In this week's update, is this the bottom and why is this time different? Local battery materials in strong intraday reversals, and the local market has played to its own tune all year. What now? My name's Garry Davis. As always, this is general advice, and please remember to like and subscribe to the video. For the last couple of weeks, I've been pointing out the boxes that have been ticked that would be evidence of a reversal or a major bottom in the market, and we certainly got a lot more evidence on Friday night. So the picture, to my mind, is finally clarified. Nothing is ever guaranteed, of course, but all we have is weight of evidence. But certainly the odds are stacked in favour of having seen a major low, the end to the cyclical bear market. This is what I've been recording over the last couple of weeks. So these are the boxes that have been ticked in the last few weeks that make this low different from what we saw in both March and May, which turned out to be just dead cat bounces. And I've gone through this every week. In March, I believed that it was, whilst I saw a very robust reversal, I believed it was far too soon. The market hadn't gone down far enough, and there just wasn't really all the boxes being ticked, particularly with respect to the level of fear that had been created. May wasn't quite as robust a reversal, and so it also failed to tick all the boxes. But I think we're pretty much there now. So this is just a recap of what was in last week's video. The spread charts were showing an element of rotation that was encouraging. The fear level determined by, in particular, the put to call ratio, but also just some of the sentiment gauges that are available in the States. They've now reached levels that are certainly consistent with major lows. Reversal in the junk bonds market, that looked better, and that additional stability in the junk bond market was encouraging to see. And finally, the news flow itself was just awful. I mean, it was hard to find a positive news item about anything anywhere. So all those things, when they all stack up, when everyone's run to one side of the boat, there's very few sellers left. There's very few buyers left. Everyone's a seller, and really the markets are just ripe for reversal. Last week I said the boxes yet to tick were that we really needed to see some emphatic reversals, both at a sector level and also particularly at a stock level, and we hadn't seen that in March and in May. Well, we certainly got a good belt of that on Friday night. So why is this time different? Well, there's a number of things, and I want to show you quite a lot of charts. This time is different because we've now gone long enough. 6 months is pretty long these days. This would be the longest cyclical bear market we've had in a couple of decades. So it's gone long enough, it's gone deep enough to qualify, but that in itself is not enough. You've got to have ticked all the other boxes above that. The only thing that one could point to, if you're a more conservative investor, is that we haven't really seen the moving average crossovers at the index level. So for those of you that are more conservative, that that don't want to move until they've got a higher level of indication about where markets are going, then that perhaps is one box that's not ticked. But I've got enough boxes ticked for me to proceed. So let's take a look at some specific charts. So I'll just start with, and these aren't recommendations or by any stretch of the imagination. These are just observations of charts that are showing the sort of pattern that I look for. And on these charts, I've also marked the reversals in the indices in March, the middle of March, and then around the 20th to the 25th of May. so that you can see what the prices and particularly the volumes did at that time, and how much different we've now got. So this is a healthcare stock. You could see quite a different response this time, and very significant move Friday night, and on very significant volume. And there are hundreds and hundreds of stocks that did this. This is Zoom, and what I'm doing here is looking at a cross section of different stocks, both large cap, small cap, different sectors, healthcare, technology. Just to give you an idea that this is not just something that was housed within one sector or one part of the market. So this is Zoom. It had been smashed since early 2021, clearly formed a base. This was the response in March to the indexes turning up. This was the response in May, a little bit better in May, and in fact, looking a bit more positive. But look at Friday night, a significant move up, the highest volume, the highest positive volume that we've had in a couple of years. Let's look at some of the majors. This is Google. Here's the two events in March and May. Whilst not a really big volume spike, they are higher, and we've certainly had 2 or 3 of them. So that's a much more encouraging price pattern than what we saw on the 2 previous events. This is Microsoft. Again, same deal. Not seeing huge increases in volumes, but then these stocks are so big that it's hard to achieve that anyway. But I think any cursory examination of this chart shows that it's certainly more positive on this run up than what we saw the last couple of times. This is a semiconductor stock, NXPI. Again, look at the volumes that we saw on Friday night. So this was the ultimate confirmation that I wanted to see. Another small cap technology stock. Again, great volume, and we've now seem to be forming higher highs and higher lows. So the small caps are now, that have been beaten down to an extraordinary degree. I mean, this one had fallen from $140 and got down to the low 20s. We're now starting to see much more positive price action. And if the big money players are now putting money back into some of these stocks, which is what you really need to see and what is causing this sort of pattern, then they're not doing that on a whim. They're accumulating stock because they believe that the market selling is done. And finally, Amazon. Again, not a emphatic volume response, but again, the price action now looks like we have most likely formed a low. As I said, hundreds and hundreds of charts that look like this, and that's why, in my view, we're now seeing a much more positive response from the market than what we saw in March and in May, which turned out to be dead cat bounces. Now, again, let me go back to the start. There are no guarantees in the market, but all we've got is probabilities, but we've now got more probabilities than we've had all year. Now, the S&P managed to close up 6.4% for the week. That's a big week. And I've just gone through all that, all that weight of evidence. We'll look at the indices in just a minute. Now, circumstances can shift. Something can always change in the news flow. Something could happen in Ukraine with the war. Something could happen to do with China. There could be central bank policy announcement that the market doesn't like. Circumstances can always shift. But at this point in time, I think what you can say with a degree of confidence is that big money has now started rotating back into the more aggressive sectors of the market. The US dollar index was down a little bit. It's possible that it's peaked around the 105.5 mark. Certainly a number of commentators have been saying that for several weeks. The 10-year yield fell from, we had a high of 3.48 last week. We're now down to 3.14. It's still in uptrend. There's no question about that. But, again, looking at what the bond market is pricing in, it's more than likely that that the 10-year yield may have peaked. And if that is the case, then the Fed won't have as many interest rate rises ahead of them as they're currently talking about. And it's quite probable that the Fed is also trying to jawbone the market down as well, rather than with threats of much higher rates, trying to take the sting out of consumption and head off the need to raise rates as far as they're currently talking about. The VIX is still elevated. 27 is still high, no question about it, but it's at least it's down under 30 now. The spread remains positive. We haven't dropped back into the negative as yet. So let's look at the indices. Start with the Nasdaq, and you can see very positive move on Friday. And look at the volumes on the up that were sustained across the week. That's a very, very positive week that we've just seen, and much higher volumes on the upside than what we've seen pretty much for the last couple of years. So certainly some encouragement. We've managed to climb back above the 20-day moving average. People that look at charts with a longer term view and need more confirmation will be wanting to see the 20-day, the green line, turn up above the blue line, which is the 50-day. And if you're even more conservative again, you probably want to see the price back above the 200-day. But that's such a long way away. That's around 14,500. We're currently in the low 12s. And by the time the index gets back up to that level, then a great deal of the opportunity has passed. So I would certainly be wanting to move earlier than that. Once we've got evidence, of course, which we now appear to have. This is the S&P 500. You can see very, very strong night on Friday. And but as we'll see on the spread charts, lagging the Nasdaq. So this line now has now formed a higher high on this ratio. So this is the Nasdaq 100 divided by the S&P index, and we've now got higher highs and higher lows. So that's what I've sort of been looking for on this ratio chart. So that's encouraging. Consumer discretionary versus consumer staples. Not a lot of change on Friday night, even though in absolute terms, consumer discretionary had a really good session, and so did retail stocks. It's just that consumer staples went up as well. So the ratio between the two didn't move much, but the absolute moves were still very encouraging. I think the consumer discretionary was up by over 3% just on the night. This is the Russell 1000 growth versus value. You can clearly see here, this is the rotation back into growth. Now let's look at what happened the previous times. What happened in March? So there's the March reversal in the main indices. We went straight up, but we didn't form a higher low and a higher high. We went up, and then we just came straight back down again. This was the very robust and very confusing rise that we saw in March, but we didn't get a higher high and a higher low. We, in fact, formed a lower low. This time, we've now got a higher low and a higher high. So, you can't deny that there's now been a shift in sentiment, and money is flowing back into the mid-cap growth versus value stocks. This is the small caps, quite a big move, growth versus value. So growth stocks significantly outperformed the values, the small cap value stocks on Friday night, and we saw some of those charts. That really is quite a big move. So it's pretty hard to deny when you look at all the weight of evidence that there's definitely been a shift in the money flows. And the important thing about this is that the funds and the big money managers, they don't change their view. They don't go into the market for a couple of days and then switch off. Their campaigns run for weeks or months to accumulate enough stock without disturbing the price that they have to make a decision and then go with it. So once a significant reversal in thinking and allocation of money starts, then it's very unlikely just to suddenly switch off, unless of course something quite dramatic changes. But leaving that aside, there is just so much evidence that the weight of money has started a new buying campaign, and that buying campaign is centered in the more aggressive parts of the market. All right, let's look at the currencies. This is the US dollar index, higher high, but struggling. This high was miles above this high. This one only just got there, and then immediately started consolidating again. If we look at the Australian dollar, pretty much the mirror. So we finished it in the mid 68 cent area on the Aussie dollar. All right, Aussie Stocks, 68.73 was the finish. Our index only did quite well on Friday, rose 1.6% across the week. And the real test will be the sectors that have been really belted very hard, quality stocks with highly probable and robust outlooks that were already quite fairly priced, have been absolutely belted to a fairly irrational degree. So the test will be how the market treats those stocks in the next week or two. So Monday, Tuesday, very important for our market. Now, our market has outperformed until just recently most of the other indices around the world, and that was because our market has a different mix, being so heavy in banks and major resource stocks, both of which have been very significantly hit. The banks for obvious reasons, because of bad debts or the prospect of bad debts and lower loan activity. The major resources predominantly because the iron ore price fell 25%. So that really spiked the major miners, and we also saw some falls in base metals prices because of fears about recession. So it'll be very interesting to see how the market treats our index next week. Let's just check in on the Australian market. So there's the ASX 200. Quite a nice turn up on Friday. Let's look underneath. Energy had been unquestionably the best sector of the year, but just got ahead of itself. And then I think I said last week or the week before that the risk around crude oil was that we got some policy change, and we got a shift back in the oil price back to perhaps under $100. Well, that almost happened over the last couple of weeks, and that's why the energy sector has experienced a fair bit of profit taking. This is the banks, the finance sector really hit very hard, and so far the rebound has been pretty mild, and for good reason. So I'll be intrigued to see how our market treats the banks in the coming week. Healthcare just really going sideways, just pretty much doing its thing. Materials came off significantly because of the iron ore price and to a lesser degree the base metals prices. This is small caps. So small caps have been hit really, really hard, but had a great day on Friday. This will be a terrific barometer in the next couple of days of the coming week. All right, turning now to precious metals. Gold was down $11. We're now down to $18.28, and I've really got nothing different to say to what I've been saying all year, and that's the gold price is just soggy. It's disappointing in this environment. I really would have thought it would do a lot better, but it's not, and that's the reality. Our Australian dollar gold price, however, remains very buoyant into the mid to high $2,600 level. Our best gold miners have all-in sustaining costs around the $1,150 to $1,300 an ounce, so they're extremely profitable. Even some of our miners that have got much higher all-in sustaining costs, around $1,500–$1,600 an ounce, are still making extremely good profits. But the market just doesn't seem to want to know about Australian gold producers at this point in time. So if we look at the global scene, GDX again was a poor week relative to gold. Now a bit of a turn up at the end, but gold stocks, the gold stock majors, the producers, significantly underperformed even a falling gold price. So that's that's just not a good sign at all for that sector. So let's have a quick look there. Bitcoin, just while I'm here, really tiny little bounce last week, but not much. This is the daily chart on gold, and we're really just at the same level that we were at in May. So really no movement over the last 6 weeks. And there's the weekly chart, so you can see it's really just going sideways. Nothing different in the gold market. Sorry, I should also just show the gold stocks, so GDXJ. And you can see we've broken some lows, clearly in downtrend and significantly underperforming. Now, better night Friday, but not looking good, that particular sector. Turning to other commodities, copper and nickel were both sharply lower on these fears about inflation and a global recession. But you know what? The supply-demand reality, which is sort of being forgotten at the moment, is that almost all battery materials in particular, but industrial metals, are facing a supply-demand shortfall. They're either in one now, or one is going to unfold within the next year or two. And that supply-demand deficit is going to last for many, many years. That's the reality. So at the moment, the recession fears, and we may not get one, then it's just swamping out the reality of the supply-demand. So the long-term outlook still remains extremely buoyant. And the other evidence for that is that a number of the base metals are actually in what's called backwardation, which means that the current spot price is higher than the futures price. And that indicates that that buyers are needing to pay higher prices because inventory levels in the metals warehouses are so relatively low. So that indicates the degree of tightness in those markets. So that paints the real picture, as opposed to the emotional picture about global recession fears. So in my view, you still are entitled to remain extremely positive about the outlook for base metals and for battery materials. In the lithium market, spot prices are still remaining extremely buoyant. I didn't put the actual prices on the slide, but just from memory, if you go back to 2020, spodumene concentrate coming from hard rock lithium was trading at somewhere in the $350 a tonne range. They're now the latest spot price achieved by Pilbara Mines was something like $6,500. So nearly 20 times what it was 2 years ago. We've seen similar sort of price rises in lithium hydroxide, lithium carbonate, and there is no sign of the slowing that that some investment bank reports have pointed to. It's just not there. And you'd have to think that the buyers aren't stupid. They know what's going on in the market. And for them to be continuing to pay these extreme hot spot prices indicates that the supply-demand balance is not even close to coming back into balance. Nor do they see the prospect of it coming back into balance either. Crude oil fluctuated over about a $10 range from 102 to 112, finished in the middle of that range at 107. There's the spot copper chart. So quite a sharp fall you can see over the last 2 to 3 weeks, from 440 down to 380. But I think I fully expect to see that turn up pretty soon, because the fundamental outlook and the reality of inventories in the metals warehouses is such that it just, these sort of price declines aren't justified. Not as big a fall in nickel, but nevertheless did fall a bit. So wrapping it up, nothing is ever guaranteed in the markets, particularly when they're really volatile and they're nervous. All we've got is the weight of evidence and the probabilities that go with that weight of evidence, and of course our own plan. And different people are going to do different things. Some are going to be more conservative, some are going to be more aggressive. So, what I'm presenting in these videos is just information, to help you align that with your particular trading or investing style. The evidence is now overwhelming for a major bottom. It's not guaranteed, but it's overwhelming in my view. However, the risks remain elevated, so suitable risk management is still vital. You always need to have an eye on the downside, what could happen to the share price. But certainly we've seen very, very significant price declines in some absolutely high quality stocks. And that, buying at these sort of levels, generally works out reasonably well. Well done to all those that have stayed the course. It's been an incredibly difficult 6 months, probably one of the most difficult periods I can remember in 35 years in the market. The reason being that so many quality stocks that were already cheap continued to be irrationally sold by significant amounts. That's been the most difficult thing, that a lot of the selling just didn't make sense based on the fundamentals. So well done to all those who didn't chuck in the towel, stayed with it, and I think from here the opportunities look pretty good from these low levels. Portfolio analyst last week talked about the coming bull market and what it offers. I think we're there now, and we also looked in detail at battery material stocks. So hopefully we'll see some very good follow through from the excellent turnaround that we saw in the Australian market on Friday. The reversal candles that we saw a lot of, where they gapped down significantly and then almost immediately turned around and just traded up and up all day, producing long candles, big volumes. They're the sort of reversals that have an extremely high probability of follow through. So let's hope that we see that. That's it for this week. I'll be back with you next Sunday, hopefully with a continuation of the good news. I'll talk to you then. Cheers.